All right, welcome back, everyone. I'm Robert Baharian, and joining me here is Matt Rigby. We've hit double-digit numbers, episode number 10 on the Wide Lens podcast, and we are recording this on Thursday, the 31st of March, 2022, not 2021, as it says on my notes here. And it's perfect timing because we're right at the end of the first quarter of 2022. So let's get straight into Matt's market minute.
What a quarter.
We'll get a wrap up of some numbers.
What a quarter. Ups and downs all over the place. All right, so the ASX 300 up until, I don't know, a couple of hours ago, up about 2% over the last 5 days, down about 0.8% for the year. I think at its worst point, it was down near 10% during the quarter. So that's about down 1% for the quarter. The last 5 days, Magellan's up about 10%, Platinum 3, Perpetual flat, and Pinnacle, which is a distributor of managed funds, up about 2%. Year to date, the retailers, I thought this was interesting. Harvey Norman up about 7%, JB Hi-Fi 12%, Super Retail, which, Rebel Sport, Super Cheap Auto, they're down 17%, City Chic down 38%, and Adairs down 25%, which is interesting given they're a furniture retailer and property. Anyway, NASDAQ up about 4% the last 5 days, down about 6% year to date. And some of the...
Do we have where they are from a high, from their previous peak? Maybe you keep going. No. I'll have a quick look.
Have a look. Some of the stay-at-home stocks over the last 5 days. DocuSign up 27% over the last 5 days. Some good earnings numbers there. Zoom up about 5%. Ross Stores, which is a discount retailer, think TK Maxx or TJ Maxx, depending on which country you're in.
Oh, what's the difference? Why is one? So it's TK Maxx here.
Yeah, and TJ Maxx.
What's it? What?
I don't know. I think in the UK it's TK, the same as here,
right,
but in the US it's TJ. Anyway, they're up about 4%. Only 13 stocks down over the past week out of the NASDAQ 100.
So from the bottom, just on that, up 15% NASDAQ.
Yeah, right.
The NASDAQ comp is up 15% when it bottomed out on the 14th of March, a fortnight ago.
Wow.
And your year-to-date number is basically about right because that's when the NASDAQ basically peaked.
What? Say that again?
The NASDAQ peaked at about the beginning of the month, the beginning of the year.
Oh, I'm right.
And
yeah,
so
yeah,
your year-to-date number is about from its peak.
From its peak.
More or less.
Yeah, that's interesting. So of the 100, 42 stocks are now down more than 10% from the year. That's a slight improvement, and 28 in positive territory. NXP Semiconductors down about 14. AMD, another semiconductor, down 14. NVIDIA down about 2. And Lam Research down about 20%. So they're all in their semi space. The S&P 500 up about 2.5% of the last 5 days, down about 3% year to date. Last 5 days, Visa's up 5%, MasterCard 2%, and American Express up about 16%. Had a nice little rally. Year to date, 45% positive. That's 224. 30% negative. And 30% down more than 10%. Wells Fargo up 7%, Bank of America down about 2%, Goldman Sachs down 11%, and JP Morgan. So the investment banks struggling there. Emerging markets flat for the week, up about down about 9% for the year. Oil down 4%, up 43% for the year to date, trading at 107. Bitcoin up 6.3% the last 5 days, down about 1.2% for the year at 47,160. So always flat for the year. That's surprising. What's it up from its low? That would be interesting.
Bitcoin?
Yeah, it's got to be more than that 15%, I would have thought.
Let's have a quick look. Up from its low, did you say?
Yeah, it was getting smashed at one point, wasn't it?
Yeah, I don't know where the... low. It's up almost 30% from its lows.
Yeah, right. Wow, that's interesting.
Of its lows this year.
Yeah.
But it's still down, man.
When was that low? Was it around the same time?
Yeah, it was.
Yeah, right.
No. I remember this episode we were jokingly, and not bragging here, jokingly claiming a bottom for Bitcoin on the 24th of January. Because remember we said, is Bitcoin a leading indicator for equity markets?
Yeah, I do remember that. Yep.
And my question was, have the markets bottomed out?
Because Bitcoin's moved.
Well, that's right.
Yeah.
But
so markets bottomed later, Bitcoin had already moved.
Yeah, like 2 days. Having said that, though, it's Bitcoin is still down 31% from its highs back in November of 2021.
Right. Okay.
So that's really interesting. I'll say I'm halfway on my target for the year for my $100,000 Bitcoin target. We'll see where that goes. So the first thing I wanted to talk about today was an end of an office era. We're in town today, and I don't know what you think, but we went out to grab some lunch today and coffee this morning, and it was pumping, man.
Yeah, right.
It was
on a Thursday as well. Yeah, back end of the week.
Yeah.
I was going to say Friday, but Thursday.
Well, I feel like more people are working from home on Fridays, and more people are in Mondays and Fridays. I feel like people are working from home, and then we've got a Tuesday, Wednesday pretty busy in the city.
Yep.
But I came across this data from Castle. I don't know who Castle are, but they had an index of the slow return to your it's the work barometer. And I'm going to get this chart up now. And what it's showing is 100% at the very far left-hand side of this chart is pre-pandemic. So when everyone was in the office back in 2020.
Mm-hmm.
And what you can start to see there is US shutdown begins in March of 2020. And you've got all these milestones like, I don't know, increased health and safety concerns drive offices to close. You can start to see a small increase over time until we hit December 2021 when we have Omicron and you see that get crushed again. It almost falls 50%, I'd say, from those levels.
Yeah.
And so occupancy, this is national US data. It's saying 38% occupancy. And I just got the latest data and I think it was just under 40. It's like 39.4% is national occupancy in town.
In the US.
This is the US. Yeah.
Yep.
And so my question is this a fundamental shift? From the beginning, I didn't think that it was. I always thought it was just, like this fad that we would see through. But having said that, China is still going through trying to deal with COVID. I feel like in Australia, COVID, we don't see the numbers anymore. I feel like it's less of a thing now. And now we've got elections coming up, so that's maybe more of a thing. But I feel like that's less of a thing. Anecdotally, our city, Melbourne CBD, is busier, nowhere near what it used to be. I'm either wrong on the call that I think people will come back to work, or I'm too early.
Yeah.
What do you think about all of this? Do you think that it is the end of an era, or do you think that this is just going to take a bit longer to sort of revert back?
My immediate thought is so work habits have definitely changed. Work from home / work in the office. I think over time we'll get back to more people working in the office, but I don't know that we'll ever get back to everyone 5 days a week like it was. So I know we're, 1 day a week we're at home, we're moving to 2. So I think that hybrid is just going to be what it's going to be. I mean, I think it is difficult for employers to say, all right, work from home, get used to that flexibility. No, you've got to come back into the city or wherever it is that you're working. I think about all the travel, the stress of travel. I mean, I catch public transport, so it's pretty chill. But I couldn't stand sitting in a car, banked up in traffic, stop, start at 8 o'clock in the morning. That would drive me mental. So if you can allow people to work from home on a Monday and a Friday, as you were saying, that's 3 days they come into the city. They get that kind of extended time at home, that work-life balance. I don't know. I think it'll take longer. I think people will always work in an office part of the time. I don't think we'll ever get back to where we were 5 days as a really hard and fast.
I talk to a lot of people and a lot of directors or MDs of firms, professional services, who say that their preference is for their team to be in the office.
Really?
Yep.
Full time. I mean, think about the cost savings as well, right? I mean, you can lop a floor off your rental agreement.
Well, it depends on how big the firm is. Potentially, yeah. Sure. I'm more so talking about sub 50 employee firms who are saying, because for them, it's less about saving money, because for them, well, I can't go do less space. It's, it
We're
might
already
be
small.
200 square meters, 400, 500 square meters.
Yep.
You're already small. It's not like you're taking up floors.
No.
And they're paying for rent for unoccupied floors.
Yep.
And so they're paying for nothing, more or less.
Yeah.
And maybe some of that will be reflected in the rental price to reflect that the city's a bit quiet or whatever the case may be. I wonder, though, if, it certainly is an employee's market at the moment. I would put my money on the fact that when we have our next recession, and once our unemployment goes from the levels it is now, I reckon the tables will turn. And if your boss wants you to come into work, what are you going to tell him or her?
Yeah.
Piss off, I'm staying at home. You're not going to have a job.
Yeah, that's a really good point. Yeah.
I reckon that's the only thing that's going to change this.
Yeah, possibly. Although I still think you give people a taste and it's really hard to get that back. And
right now, it's hard to get that back.
Yeah,
but I reckon
time,
if you can't get a job right now, everyone can get jobs.
Right? You're right. If you can't get a job, you're whatever. I'll do whatever I need to. Go into the office 5 days a week. That's fine. Just I need a job.
The good thing is recessions don't last as long as non-recessionary periods. So you've got to suck it up for a little while. The other thing I wanted to touch on was Castle also did. There's some numbers on what they call recreation activity versus office occupancy, and I'll just read this before I bring the chart. Americans' participation in public activity has rebounded significantly since March 2020, as seen in attendance and traffic data from major recreation venues such as TSA travel volume, dining reservations and major sport event attendance. But office space attendance is picking up more slowly, based on Castle Daily Access data from 41,000 businesses nationwide, and remains well below pre-pandemic levels. So I want to get this second chart up, and what it's showing is we've just gone through office occupancy. I think, is it showing office occupancy here? No, I can't. Oh, no, there's your 40%. Office occupancy versus everything else. Mm-hmm. And so it's the same methodology that they used for the previous chart.
Yep.
You can see the purple line above the 40%, which is 53.3% at movie box offices, so people going to the cinemas. Yep. 86.6% open table diners, so people booking for restaurant reservations. TSA checkpoints, people travelling. That really, I found that interesting. We're back to 90% of pre-pandemic levels of people travelling in the US. And I know in Australia, anecdotally, I talk to a lot of people that are travelling a lot, to Brisbane, Sydney. It's starting to come back. I don't have any data, so I can't comment on the accuracy of that. Look at NBA games, 94.1%.
I was looking at that's crazy. It's basically back, right?
I'd say travel, dining, and maybe entertainment, and maybe the movies is more so a function of, well, I've got Hulu, I've got Stan, I've got Netflix, I've got Disney. I don't need
good films that are out. I mean, look how volatile that number is. I mean, that's all over the place too.
Actually, interesting. I didn't realise that was probably almost as high. I wonder if that's seasonal though.
So in January, that looked like it hit basically 100%, and then it's dropped down to like a 42%. And, I imagine that one's probably more sensitive to COVID outbreaks or concerns than...
Or good movies or shit movies.
Yeah, absolutely. I mean, there's probably, whether it's hot or cold, snowing or raining.
That's why I wonder if there's some sort of seasonal adjustment here. But so, look, you touched on it before. You said that the office is probably going to be one thing that's not going to come back to pre-pandemic levels. I think you're right. I think that's going to be the case, but I don't think it's going to be as extreme as it is now. I reckon it wouldn't surprise me. People are 1 or 2 days a week at home, and if that's what you call a hybrid split, then I think that's probably where we're going to land.
Yeah, I agree. Yeah, I mean, it was never going to stay as it was, and I don't think it'll go back to where it was. It'll be somewhere in the middle and probably closer to where it was than where we were.
Do you think this is a fundamental shift in economics and in business and the way the economy functions? Almost like, you know, you look at manufacturing and how that's shifted over the course of the last 50 or 100 years.
Yeah, it's interesting. I've often wondered, like, what happens to all this spare space? And maybe to your point, like, think about a recession. Businesses close, there's vacancies, and then new businesses start up. So maybe there's a fundamental permanent shift in how many hours a week you spend in the office, but all that excess office space is taken up by new businesses or businesses expanding over time. I don't know if I'd compare it to the manufacturing. I don't know. My gut feel says no. It's not a complete disruption. It's just a tidal shift, if you like. I don't know. Time will tell. We'll check in 10 years' time and we'll see. But yeah, I just don't know if it's as extreme as that. Maybe I'm wrong. I don't know. What do you think?
I was just trying to look it up now. I could be wrong here. Clemenger, who's the advertising PR group, they just took up space in where I think it was Maya in Bourke Street Mall.
Yep.
And I think Rod and Gunn were there. And so they've moved into, I think, 7,500 square meters of space they've taken, which is pretty big.
Yeah.
I can't find it now, but I read that yesterday. And that's like a big win for. I mean, they used to be on, I believe, St Kilda Road. They're in town now.
Yeah, okay.
I think that's a big win for Melbourne City Council, and I think for business. And so they'll have however many people. But I mean, they're sort of more creative, you know, advertising, and for them to go from where they were to where they are now, that was interesting to me, because I would have thought that sort of professional would have been more of a work from home hybrid. But that's yeah. But if you're there trying to collaborate with a team and you're working on a project, I don't know how you do that remotely, to be brutally honest with you. I struggle with it.
It's probably not as free-flowing. It probably makes more sense to be in the office, at least part of the time.
And look, the building that we're in was in a textile building. So the textile manufacturers, I believe, and this whole, you know, Flinders Lane, but that's 80 years ago.
Well, I was chatting to one of the builders, so they're doing a bunch of work on a number of floors, and he was saying they're combining, say, 3 offices into one, and of the 5 or 6 floors they're working on, 4 or 5 of this, basically one hasn't been leased out, so all the others have.
Oh, right.
Yeah, which was interesting. So,
I reckon price plays such a big role in all this.
Yeah.
Once prices will adjust, and the free market will work itself out. There's no way, you know, this landlord could sit on this asset at a 70% vacancy rate. No way. They will have to do something to incentivize, and someone will just go, you know, this is just too cheap. I'm going to secure a 10-year lease.
Sign a long lease, and at some point that'll roll off and prices go up, and we end up back where we were or where we would have been. Interesting. All right, so next thing I wanted to chat about, shipping delays are back, and this is a bit of a, bear with me here, there's a fair bit going on in this topic, but essentially I'll start off with China and COVID. So I think we alluded to it last week or the week before that China's pursuit of zero COVID cases is going to impact on shipping supplies and shipping deliveries, and some of the evidence is really starting to come out and show that is the case. So I just I took a couple of snippets here. So Trans-Pacific delays, so between Asia and the US, have largely shifted to Asia. So previously it was ships off the port of, where is it? LA, and I can't remember the other one there.
The west coast of the US.
Yeah, west coast. So the ships just banked up.
Yeah.
And that shifted to Asia. So China has 14% more vessels off the coast of their 2 major
shipping ports. So are they
ports.
coming in, or are they going out?
They're coming in waiting. So they're sitting there
waiting.
Where
are they coming from?
All over the world, but this is Bloomberg, so probably US specific.
Right.
So they were talking about Shenzhen and Hong Kong, locking down, and then the knock-on effect to the South China hubs of the shipping hubs there. And so they were saying that 14%, or about 174 vessels, are now anchored off the coast of China, waiting to get in
dock, yeah.
to load up to then ship off again. So that's, basically it's gone from a can't get stuff off the boat to can't get the boat in to load it up, on either sides of the Pacific there. And there's I don't know if hopefully we can bring this up. So there's a couple of charts in this article, March congestion. So it's looking at Shanghai, Hong Kong, LA, Long Beach. That was the other one. LA and Long Beach are the two major ports on the West Coast.
Yep.
And Qingdao, I'm sure I've got that wrong. But anyway, and just looking at the number of ships sitting or queuing up or in the vicinity of the port area. And, you can see a real decided decline in the US side of things and a spike in the China side of things.
It's almost like it's so if I look at Long Beach, LA, it's almost halved from the back end of last year. So it's sitting at 110 at its peak. You're now sitting at 40. Is it 40? Is it number of ships or number of vessels?
Container ships.
Number of container ships. So it's more than halved in the US, but it's more than doubled in Hong Kong, Shanghai. Yeah, wow.
Yeah, if you hover over the graph, so the 25th of January, there were 88 off Long Beach and LA. Is now 42. That's a huge drop. So I guess that has a knock-on effect to, what does that mean for retailers throughout the US? So they've ordered all this stuff. They've been waiting for it. All of a sudden, all these ships are now getting unloaded onto trucks, being shipped off all around or trucked off all around the country. And that conveniently brings us to the next article where there was an article from, is it Ross Stores, which is why I mentioned them earlier.
Yeah,
basically
the Wall Street Journal had that article.
Discount retailers, yeah. So Ross, TK Maxx, there's a couple of them. Anyway, they were basically saying, Burlington, that was the other one. They were basically saying all the prime retailers, I'll say Gap and Nordstrom, have got all this stock coming in at the end of season and they can't get rid of it.
Yeah.
So they're selling it on to these discount retailers and the discount retailers are loving it. Like they've got so much stock. So they're almost a price maker now, whereas they've always been a price taker.
Yeah.
So they're setting the terms. I think from what it sounded like, the retail side of it, the consumer side, had still been fairly strong, but they're able to get a lot of supply in at lower costs, and that in demand.
Do you
is
think
still
that's just
there for
helping
them.
retail sales as well at the moment? There's, I don't know how much of a proportion, the discount stores make up of the overall picture. I mean, the other thing we looked at last week was retail inventory is just really skyrocketing.
Yes.
And I wonder how much of what is going on is causing that to really spike up.
Yeah, and I think I may have commented that it could be because of these, there haven't been any stock for so long and all of a sudden all these container ships are getting unloaded and you've gone from hardly any stock to way too much and you don't know what the hell to do with it. So that's really interesting, which kind of leads on to, I guess my question is, what happens next? I mean, do retailers, there's, what are we at, 2 years now of these retail supply chains or just supply chain disruptions generally? Do retailers start to move, or manufacturers start to move manufacturing out of China as a big hub and into other areas of the world?
I think these second and third order events are really hard to tell. Like, how we were talking a little while ago about Ukraine and Russia, or Ukraine producing 20% of the global wheat or whatever. What I subsequently found out was that only 1% of that wheat gets exported globally.
Oh, is that right?
Yeah.
I thought that chart we're looking at was the exports. Maybe not, it's just production.
It's production, yeah.
Okay.
So a majority of their wheat
is consumed internally.
Is consumed.
Wow, okay.
So it's stuff that I certainly wouldn't have thought about. You think that they produce that much, and you think, wow, okay, so then that must make up the global wheat. But that's not the case. No. There's a few things that I've been reading. Who was talking about? Was it the Wall Street Journal or Bloomberg here? Yeah, a couple of articles on Bloomberg talking about deglobalization. I think that's the kind of the word now at the moment that everyone's
The new
talking about,
catchphrase.
which is, so what we're going to go from is a world of globalization to a world that is being deglobalized. I remember sitting in a Magellan presentation, a roadshow many years ago, and when the 3D printer came in, and the 3D printer was becoming more commercialized, and I remember Hamish talking about 3D production, manufacturing, and so on and so forth. And the thing that I was really curious about at that point in time was, does this mean we go from globalization to deglobalization, where I don't have to go overseas to produce something anymore because I've got a commercial 3D printer now. I can just print stuff whatever I want here onshore. Yep. I'd like to think that I was well and truly ahead of my time, but it was just maybe pure coincidence more than anything. But so this is Larry Fink, who says,
who's the CEO of BlackRock?
CEO of BlackRock. The Russian invasion of Ukraine has put an end to the globalization we have experienced over the last three decades. The war marks a turning point in the world order of geopolitics, macroeconomic trends, and capital markets. And what he goes on to say is that we need to reevaluate our dependencies and reanalyze our manufacturing and assembly footprints. And so what's going on now is if you're a manufacturer, you produce, I don't know, pants or shoes or something, you're getting bits and pieces from all around the world. All of that then gets shipped to China, where you manufacture, and then that gets shipped to, let's say, the US, for example, and then you've got a main dock whereby you then start distributing globally. So what a lot of companies are talking about, well, I shouldn't say companies, but what is being spoken of at the moment is, rather it all going to the US to be distributed, they have distribution points in where their main customers are.
Like
so you
regional
might have
hubs.
Yeah,
almost.
so you might have one in North America, you might have one in Australia, you might have one in South America, or you might not need one in South America, you might need one in Asia. And so you've become, it's sort of this quasi-globalized, deglobalized world where you're not relying on shipping, you're not relying on those logistical errors or problems that could occur along the chain. So look, I don't know where this is going to land. I think maybe we're extrapolating what's going on right now. Maybe we're becoming so risk averse that just because we've experienced one thing that we're going to completely go the opposite way. From having. I mean, remember when people used to manufacture in China? Like, that was the thing to do, and then it became too expensive because not so much it becoming too expensive. Manufacturers were losing quality control.
The cost versus quality benefit wasn't there.
Correct. And so you'd have an employee in a factory leaving to go to the next factory because they're paying them $1 a month extra.
Yeah.
Right. And so moving manufacturing back to the US. I think that trend's been probably happening for a little while, I reckon.
But does that increase, I guess, that trend? Does it get more momentum coming back?
I don't know.
Onshoring or whatever you want to call it.
I don't know. I'd like to think so, but I'm not sure. I was listening to a podcast and there was a guy talking about the fact that Apple is going to be your barometer. And so Apple meaning, so if Apple's the biggest, has the greatest market share in China, you and I were talking about this the other week. With all of that, what's going on and these sanctions and whatnot, our company's going to pull out.
Oh, okay.
Right?
Yeah.
And so we're talking about Apple having the biggest market share in China, with their manufacturing, their distribution, their sales, and so on and so forth. And what this guy was saying is, it's all good and well to think that we're going to go to this deglobalized world, but the thing that is going to verify that that's true is whether Apple's in China or not, and whether they're manufacturing in China or not, whether they're distributing in China or not, which I thought was an interesting take. Because how do you quantify, how do you measure we've gone from globalization to deglobalization?
Yeah.
I don't know what the answer is.
I don't know. No idea.
I don't know what the answer is.
There was also kind of, to that point, a Wall Street Journal video, and they cited Benetton, the clothing fashion retailer, and they were saying that they're going to cut production in Asia by half over the next year or so.
Right.
And moving to almost regionalized manufacturing. So Turkey to do Eastern Europe, I had to write it down here.
That's what I was
Egypt,
trying to explain
Serbia,
before.
Croatia, yeah. So they've got regional manufacturing hubs.
That's right.
So it's a regionalization as opposed to a globalization, which I think is what you're saying. So, and that kind of makes more sense, right? I mean, I think the shipping delays and everything is highlighted that if you've got everything in one country and everyone else does as well, and for whatever reason they can't get stuff out, you're screwed.
Yeah, that's right.
So it's got to be a risk management question in there as like, all right, do we start to move this around the world? And yeah, for years, Africa's always been touted as the next China, the next low-cost manufacturing base. Maybe it's Africa, South America, a few other places. It's not just one place anymore.
But I also think, I mean, even if we look at Australia, I know, especially in food, like a lot of manufacturing is done overseas, snapped frozen, shipped over here. The cost of doing business here is a lot higher. And I think consumers, if that's what you want, then we just need to work out what the benefit is and whether or not doing that here. And are people going to absorb the 40% increase on product? As you know, I'm involved in a food company, and when we tell people the price of our product, they go, "Oh, that's very expensive." It's like, well, it's made here in Melbourne, it's manufactured here in Melbourne, it's stored here in Melbourne, it's shipped locally, or it's transported locally.
Yeah.
People want all the bells and whistles without paying for
cost.
it, and I think maybe there's going to be some sort of maybe there needs to be a bit of an adjustment there from an expectation perspective.
Yeah, possibly.
Do you want to touch on anything else there, or should we maybe?
No, I think let's skip on.
Let's jump on to an extension of the conversation we were having last week, which was the recession oracle. And I have not seen one article that does not talk about the inverted yield curve or the 10s minus the 2s, which is, or the 2s minus 10s, which is showing the inversion and the inevitable recession. So Sentiment Trader had this interesting chart, which, I mean, it doesn't matter what your argument is, you can always find some sort of chart or data to support your point of view. But I thought this one was interesting. The average yield curve is far from inverting. I'll read this out now, and then I'll bring up the chart. So we're looking at several short-term maturity. Hold on. Using 55 different combinations of treasury yields from 11 different maturities, more than half of the yield curves were inverted. Now, if I just bring this chart up from Sentiment Trader, it is showing the median US Treasury yield curve spread. And it goes on to say from 1966, this thing has also predicted every single recession ever since the late 60s. But if we look specifically at 2022, the spread of this average Treasury yield is actually nowhere near inverting.
Yeah.
And so based on this data, that there's a very low probability that the US would be in a recession anytime soon. What do you think about this?
Yeah, I thought this was really interesting because it certainly goes against everything that we're reading at the moment.
That's right.
And I think the point of difference is they're taking multiple combinations of treasury yield, differential. So that is, it's not just the 10s and the 2s, it's the, 5s and 30s and whatever 20s, it happens to be. So yeah, I thought this was really interesting. It's probably a much more comprehensive view. I don't think that'll stop the hysteria that will inevitably unfold as if the yield curve continues to invert or invert more. I did think this was really interesting, and I mean, look at the consistency there. That's, it's pretty strong. Every recession since, what do they say, 1960? Well, 1970 is the earliest recession here. So, how many is that? 1, 2, 3, 4, 5, 8. And it's absolutely nailed it every single time. Although, look at the 80s. I mean, it was inverted for a pretty considerable period, relatively so. All the other ones are brief inversions. And brief is probably 6 months.
So do you think we're we're headed for a recession?
I still do. And that's not to say this won't continue to evolve and maybe move down. But, the more I'm reading CEO comments of retailers, they're noticing, a shift in sentiment. The more you listen to the Reserve Banks talk about, we're going to raise rates, ratchet it up, 50 basis points, for X number of meetings. There's a concern. So maybe I'm wary, not concerned, that there's a high probability that
how else do you
central banks
slow down
overshoot.
a hot jobs market? Because that's the thing, right?
But job market are hot, but wages aren't going up like it's a hot jobs market. When was it? Back in, that's probably 2018, 17, 18, 19. Jobs markets were pretty hot, but wages weren't going up. And there was this kind of conundrum that no one could quite work out. Why is it that there's, so few people looking for work relative to historical levels and wages are just not going up? And that seems to have continued to play out.
Sorry to jump in there. Wages in the United States increased almost 10% in December of 2021 over the same month in the previous year.
So of 2020, is that a
lower base
12-month period? Yeah, I don't know. That's certainly higher than what I've been reading. It's looking more like 2 to 2.5%.
No,
but then there's a lot of the tech companies. Apple is one and I know. Is it Facebook or Google? Maybe it was Facebook because they can't use stock-based compensation anymore because the stock's in the crapper, that they now have to pay more, bonuses to keep people, from jumping over.
Apple just did a round just to retain their staff.
Yeah. So, does that go towards wages? I don't know. It's not a permanent increase in the wage. It's a bonus. I don't know how they calculate it, but I haven't read that it's at 10%. But maybe that's from the 2020 lows. Yeah, well,
they do come off some low bases, but I think the wages are probably higher than we think, and maybe a recession is the only way to just shoot that down and let it sort of recover back from that again. Look, a couple of other things that I think we should just touch on before we move on to the next topic. Just bring this chart up here, which shows the 10-year US Treasury yield downward trend since the mid-1980s, breaking out from the downward trend we've seen for the last 45 years.
Yep.
I don't know. Is this a good thing? I don't know how much lower we can go. I don't think we can see negative real yields for forever. So I think maybe we are at a new beginning here, and those that want greater return on their bonds, like I don't know how you're going to get yield. I don't know how you're going to get that unless you start to see some interest rate rises. So that one's a bit of a one step backwards for two steps forwards kind of thing. But unfortunately, I just feel like people can't digest this short-term decline in capital price, so that you can start picking up treasuries or bonds with new maturities that have a high rate of return.
Yep.
Finally, this was from Bloomberg. The Australian yield, 3-year Australian yield, coming back to where it was back in 2014, is it? Yeah, since 2014, which I didn't realise how sharply the Australian 3-year yield had increased. And I think that's probably why everyone's sitting here saying to the Reserve Bank, you're behind the curve, behind the curve, behind the curve.
Get on with it.
So
I'm not.
You're not what?
Just hold off. Don't raise rates. Just keep them low.
Well, the other thing, actually, why don't you jump onto the next one, because I just realised I read a piece the other day which I think fits into your article here.
All right. So this one was a tweet coming out from Cameron Murray, and I believe he may have retweeted it from the CBA. So CBA came out with this chart on Aussie mortgage payments, and they split it out, the total payment, what's the principal component and what's the interest component, which we've seen a million times. But what CBA have done is then gone on to say, okay, what would these payments look like if there was at the current rate, if rates went up to 1.25%.
Oh, the cash rate.
The cash rate, yeah.
Gotcha.
And if the cash rate went up to 2.5%. And I was a bit surprised that at 2.5%, the total, I guess the percentage that mortgage payments represent in the total household budget wasn't higher. So they're saying
what
it's at the peak of 2007.
So at the RBA cash rate now, the total mortgage repayments represent, let's say, 14% of household income.
Thereabouts.
And so if that goes to 1.25%, it represents like 16%.
15, 16%. And
at 2.5% cash rate,
it represents about 18%. I was looking at it going, I find that really hard to believe. I don't know.
Is that like a so what moment now? Like, what's your point?
Well, I guess my first thought was how many old, almost paid down mortgages are there in this data? How many mortgages were taken out in the last 5 years, and do they look drastically different to other mortgages? Because I looked at that and I go 18%. In my mind, that doesn't sit where I kind of thought it would.
Well, that's the data. It doesn't matter what you think. This is what the data says.
I know it doesn't matter what I think, but I wonder whether it's anchored in old mortgages that are almost paid off, about to run off, and whether newer mortgages have been taken on in the last few years, which are significantly higher already a higher proportion of income.
I don't know. Why would... Yeah, I don't know why they would... Isn't it just total mortgages?
Total mortgages... as a percentage of household income. So
what are you saying?
So what I'm saying is those that have taken out mortgages in the last 5 years, I wonder whether their repayments are a much higher proportion of their household income than those people who have taken out mortgages 20 years ago. And you've refinanced at lower rates. They've got a much smaller mortgage. I don't know. It's interesting, but I was surprised it wasn't significantly higher. I mean, if it is only 18%, then what's everyone worried about?
Well, that's the thing. And look, that's a great question. I don't know how you would then break that up. The way I see it is, it's just total. It's just total loans against the income, and as a percentage. Maybe there's more to it than what we're seeing here. What I read, the banks are already slashing their variable interest rates.
Slashing?
Yeah.
Not increasing?
No. So the fixed rates are increasing.
Yeah.
But the variable rates, they're already cutting variable rates.
Down to what?
I don't know. You're catching me off guard here now.
That's my job.
So they're saying
that's surprising.
Yeah, big four banks slash mortgage rates before interest rises. I don't know if I'm going to be able to access this. So this is 4 days ago, AFR.
Okay.
The big four banks are slashing their variable mortgage rates to win market share ahead of a pending Reserve Bank interest rate rise expected as soon as June. On Friday, CBA cut its lowest variable rate by 0.1% to 2.19, following a cut on Thursday by Westpac of its lowest variable rate to 2.09%. Those low rates apply to borrowers who can put down a deposit of 30% or more. So it depends on your LVR.
Oh, that's interesting. Yeah.
Or more, as the banks compete for lower risk borrowers. So the higher risk you are, you're going to pay.
The more you pay. I mean, that makes sense, right?
You don't have the deposit.
Yeah.
You get a bigger loan, and you got to pay a higher interest rate.
That's really interesting.
But variable mortgage rates have been lowered across the board, according to Rate City, which tracks financing and deposit rates. About 35 lenders now are offering variable rates below 2%.
Yeah, right.
So it sounds like to me it's the cuts of variable mortgage rates coincide with dramatic increases in fixed rates. So they're cutting variables, increasing fixed. So let's get them in. Let's get them to borrow the money now. And do we raise rates later? How does
absolutely.
Why would anyone fix? Who would fix the loan?
Right now? I mean, I fixed late last year. Pretty happy I did at 2%.
Yeah, but what if we have a recession soon and the banks and the RBS starts... So
they've fixed part, I should say. Okay. Hedge my bets. Because that was the thought.
What did you fix that?
I'll fix it, I think 2.09.
That's good.
For 2 years.
2 years.
Yeah.
Yeah, but see, when did you do that?
But I'm hedging my bets. November,
2.09.
And the variables, ANZ, get your bloody variables down. So the 2-year fixed rates, I've been watching them. The 2-year fixed rate at ANZ now is 2.8. I reckon it's close.
Is it a home loan?
Yeah, it's close to 3% maybe. So they've jumped up significantly. Their 3 years have popped up and across the board. So yeah, I've seen that fixed rate. I haven't seen the variables drop. That's really interesting. But I've always suspected that when rates start to go up, or wondered whether the banks tack on a little bit more. So the RBA increases by 25, the banks increase by 28. It wouldn't surprise me at all. I mean, they've got margin expansion. It's just there. It's waiting. They're just waiting to take it. I'm sure they're chomping at the bit to raise rates.
Yeah. Well, it was surprising to me to see a cut in variable rates. The rise in fixed rates makes complete sense to me.
Yeah. Yep.
I don't know. I mean, I guess they'll cut the rates until they fill their books up. Done. And then,
well, it's a market share game, right? I mean, it always is. So we were chatting to a broker the other day, and he was saying, right now these guys are competitive. They're looking for market share, and these guys aren't because they went through that, 3 or 4 months ago, and they've got what they can handle. They've got their funding. They've lent it out, and they don't care.
Yeah. Let's quickly talk about what happens given we're talking about rates, we're talking about recessions. Bloomberg had this article, what happens to stocks when the Fed hikes, a historical guide. The S&P 500 usually has high returns 12 months after the first hike. So we're talking about the very first hike here. Stocks poised for more swings as Fed grapples with oil surge. Quote, history suggests US stocks are poised to experience more volatility. Can't go wrong with more volatility. Following the rise in rates, but that doesn't mean the bull run is over. In fact, the previous 8 hiking cycles, the S&P 500 was higher a year after the first increase every single time.
Wow.
Let's go through this quickly. I'll bring this chart up. What happens after the first Fed rate hike? We go through 9 cycles here from 83. And it shows the next 3 months, next 6 months, next 12 months. Just jump to the bottom, which looks at the percentage that is positive during that time. The following 3 months, 50% of the time it's positive. The next 6 months, 75% of the time. The next 12 months, 100% of the time, the stock market is positive. I'm not saying it needs to go bonkers.
No,
just saying it's
up.
positive, right? It's up.
Yeah.
I mean, look, probably the average, and the average is 10.8, median's 5.6.
Yeah.
The average is very much driven by 97, 88 with those big run-ups after the first rate hike. So you strip those out, you look at the median, that's,
5.5%, 6%. That's
for the
not
year,
bad, right?
All things considered.
Yeah.
Let's bring up this next chart, how the S&P 500 sectors perform in Fed rate hike cycles. I was surprised to see technology up there being the number one sector of 20% average returns in a hiking cycle.
So was I. That's crazy.
I would have thought that, I can see energy up there, real estate, I can understand.
Financials? I would have thought they'd be up there.
Where are financials? Down towards the bottom down
under
there.
the average. So S&P's
just goes to say, just own the index and you'll be right.
This is telling you just buy technology.
Well, let me finish. In the past, this quote, in the past 3 decades, the Fed has taken on 4 distinct rate hike cycles. None have been detrimental equity markets, and technology, which has seen wild swings this year on the prospect of faster rate increases, is typically among the best performing S&P 500 sectors during those cycles, with a gain of nearly 21%. But overall, leadership varies, with no sector outperforming in all 4 instances.
Oh, okay.
So just because the average gain's been that doesn't necessarily mean that they've always been the outperforming sector in all of those scenarios.
So why has technology done so well if we're looking at higher discount rates, lower future cash flows back into today's dollars and lower valuations?
I wonder if it has to do anything with the interest rates rather than the market going up. So if you see the market going up, I don't know. Using your methodology, it's counterintuitive. Yeah. But I wonder if you ignore the rationale and the common sense, which a lot have ignored recently. I wonder if it's just this market's going up, let's get back into what was winning last year.
And this is from the first rate. So I wonder if it's similar to what we've seen, and that is markets or technology shares fall in the lead up to the first hike. First hike happens, everyone goes, this isn't as bad as we thought.
Yeah.
Technology runs more because it was down more leading up to it. And,
Because we're already seeing it, right? Like we already saw, the NASDAQ was down 21% from its peak. You said it's down 8. So it's, there's a 12 or 13%, rally there.
Yeah.
And we did talk about potential bottoms. We did talk about returns from these extreme levels. I then just want to maybe just finish up on this before we move on to director's cuts real quick. This is from Bespoke. Came out this morning, I think. I thought it was just really timely. And I'll just bring this chart up now. The S&P 500 total return, percentage of time positive over various time frames. 1, 3, 6 months, 1, 2, 3, 5, 10, 20, 30 years. And so the shorter the time frame, even though the odds are in your favour for the total return to be positive, doesn't say it has to be 5 or 10%, it just says positive. Positive. It's above zero. 63% probability, or historically. You widen your viewpoint to 3 months, 68, 6 months, 71. Look what happens when you go from 1, 2, 3, 5, 10 years. 20 years is, that's really long term. But I think like anything above 70% probability, like I reckon that's a pretty good odds. But in that 30%, the market could absolutely tank and you could get crucified down 50, 60% in that 1 year.
Yeah. Yep.
So I thought this was just a nice way just to remind ourselves and remind investors that, yes, there is a lot of noise that goes on day to day with headlines, and whether it's shipping or interest rates or geopolitical risk or yield curve inversion or whatever it is, there's always going to be that. But if your portfolios are designed fully knowing that any of these risks that are present all the time could pop at any moment and you're okay with that, I reckon that's when your portfolio behavior and your investment behavior becomes so powerful, and that's the edge you have over people who respond and fund managers who have to liquidate holdings because there are more people wanting to withdraw money out of their fund than not.
Yeah, look, I've seen plenty of research over the years that says 10 years. If you hold for 10 years, you're pretty much not going to lose.
Yeah,
it's just the probability is so low. This at 94. I've seen others at 100 as well. 20
it depends
and 30
on what market
years.
you look at too, right?
But you think about superannuation. Here a 30-year-old, 35, 40-year-old, 10 and 20 years. They're give me 30-year timeframes is what you really should be looking at, and just get in, load up. Don't worry about timing. Just every month it goes in, invest it, put a bit of extra money in if you can. You've got that long time frame. You almost, I'm going to say almost, but guaranteed not to lose.
When you talk to people who have managed wealth over generations, when they say if your game plan is 100 years, then why do you worry about what happens today or tomorrow?
Doesn't matter,
right?
At all.
Who cares what happens in 2 years, 3 years time?
10 years doesn't matter.
You can be patient. You can be disciplined. You can be thoughtful about how you allocate capital. You can write things out. But I think it goes back to getting really clear on what you're doing it for, and also your asset allocation. There's research that shows asset allocation drives over 90% of your returns. Yet so many of us focus on whether we should be buying ANZ or NAB or JP Morgan or Apple. Like, I think we spend so much time on the things that have the smallest impact and the lowest time on the things that have the biggest impact. And I think they're the things investors should be thinking more about. Let's jump to director's cuts. Have you got anything, or
yeah, I'll jump in first. So something out of the Academy Awards that
was that fake?
No, I don't think it was. I think the crowd thought it was all part of the show until he started mouthing off and just lost his marbles. The marbles were all over the floor. He just lost it. Like, flat out lost it. I actually saw. And this is not what I wanted to talk about, but I saw today that the Academy actually asked him to leave after that, and he said no. He wanted to stay in the hope of winning Best Actor. I think he won.
Chris Rock.
No. Will Smith.
But didn't he win it?
Yeah, he did. But they asked him to leave after that incident before the award, and he said no. So that's interesting. Anyway, so it's not the slap that I wanted to talk about. Coda, which was the winner for Best Picture, is the first time a streaming service has produced the Academy's Best Picture winner. And that was bought by Apple in 2021 for $25 million. Which is crazy to think about. Netflix hadn't won it before this.
Hold on. What about... Didn't Bird Box... I'm just looking at it now. Didn't Bird Box win something with Sandra Bullock with Netflix?
I don't know if that was the Academy Awards. Maybe that was the other one with the ball, the whatever that one is. Yeah,
I don't know what you're talking about. But anyway.
What's the other Academy?
The Oscars.
Something else. Anyway, so...
We're not film people, man.
No, clearly. So that Apple, first streaming service to win Best Picture. Will this be a turning point for Apple's offering? Apple's Apple Plus service has always been a bit of a third-rate player. It's certainly behind Netflix. I didn't even know
Apple had a streaming service.
Man, it's pretty good. Ted Lasso, get on board. It is one of the best shows I've seen in the last 5 years. That's not my review this week, but it's a bloody good show. Will it be... they're behind Netflix and behind Disney Plus. I don't know about Stan and Binge. I don't know even if what their numbers look like. But in the US and around the world, they're certainly behind the other two.
That goes back to this conversation we've had a number of weeks ago in this show was about how companies are not companies like they were 10, 20 years ago, right? So
absolutely.
Apple's got... I didn't even know they had a company called Coda, right? So they've got...
It's a movie. Not a company.
Oh, sorry.
It's the Best Picture winner.
So they paid $25 million for Coda.
For Coda, the movie. The rights to the movie, yes.
I'm listening very carefully to what you're
saying.
Clearly.
But they're so diversified. They're such a conglomerate. They can afford to have these little add-ons and lose money. It doesn't matter. They've got $250 billion in cash. They can afford to lose money, pick up a couple of really good... Yeah, so they bought the rights to the movie like Netflix and whoever else. Yeah, so they can afford to have these loss makers, and Amazon's a great example of this. And then, they just put money in it, come up with really good shows. Eventually it becomes a big money spinner.
I read the stat that the showtime that a new show or a new movie has on the likes of a Netflix is 2 weeks. You've got 2 weeks for that thing to write and it's dead.
Really?
Yep. And so what they need to do is produce, and that's why there's so much competition now. Yeah. You've got to produce a ton of stuff to constantly be at the forefront of the consumer's mind and just grabbing their attention. I saw it's being advertised everywhere now. I don't know which show it is. It's about the Lakers dynasty. What's that called?
Winning Time.
Winning Time. I don't know who's is that Hulu? Who's
HBO. Got that? I don't know.
Whoever's got it, right?
Maybe we'll have to wait for the next segment to find out.
but that's like the thing now. And so once that's gone, someone else is going to have the next thing. And so I don't know if anyone's ever going to have like this monopoly. Because I reckon, pricing pressure maybe will just get so saturated where consumers are just spending... I've got 2 or 3 streaming services, not just one anymore. Yeah, I don't know. I think it's a really interesting space.
Yeah, no, I think you're right. But I think it helps to have deep pockets. So Netflix is spending tons of money on production. Apple have got the money to do that sustainably. Whereas, you've got to think Netflix at some point they've got to start making profits.
Or maybe Apple buys Netflix. I don't know.
Maybe Disney. Again, they've got big pockets. They can keep doing it.
Well, the big just get bigger. Talking about Apple, just super quick, I just thought this was really interesting. A headline from Bloomberg, Apple is working on a hardware subscription service for iPhones. And my understanding is that it's not going to be like a 12-month contract divided by 12 that you pay off the hardware. It's based on the hardware that you're buying, the software you're subscribing to, and you pay like this monthly subscription fee. And they're trying to move away from these lumpy sales in their revenue to create more recurring revenue, not only in their software but also in their hardware. There's no details. Whoever's leaked the information's doesn't want to give any more information, which is fair enough. So I don't know how it's going to work. We probably don't have time right now to talk about that.
Which is essentially what you do now when you get a phone contract. Just you're paying for that subscription for the hardware to.
That's right. Yeah, it's a hardware subscription. Correct. Yeah, okay. So they're trying to. That's interesting. They're trying to get into the. Just getting that cash flow coming through, I think, is key.
Yep.
Let's jump into tips and recommendations. What do you got for us? Well, I think I might guess.
Yeah. Far out. Winning Time. So as alluded to, So it is a documentary put together by HBO, which is a big US producer, and they've got their own streaming service over there. And basically, it's based on I think it joins the story in 1979 with Dr. Jerry Buss, who's the legendary Lakers owner. Bought them in '79 for, I think he paid like 30 million, 60 million. I can't remember now. Wasn't a lot, and he basically
Wasn't a lot.
Well, now it's worth 4 billion.
5.5.
5.5. So he had this vision that people...
He bought it for 24 million.
24 million, there you go. So people want entertainment. At that time, they thought there weren't enough white players in the NBA. That was kind of the prevailing sense and why people weren't going to the NBA. And his vision was, let's just make it glitzy. Let's make it flashy. Let's, showtime. Let's really put on a show and make it not just about the basketball, but it's an experience. And so I'm 2 episodes in. It's annoying because they release 1 episode every week. So I hate that.
Well, just wait till they're all out.
Well, I could just wait, but I've started watching it. So, and I needed something to review. But anyway, so their first move was to draft the legendary Magic Johnson, who was probably my all-time favorite player. Just such a legend. Oh, he was incredible. Changed the game. But anyway, so and it kind of follows the story of Kareem Abdul-Jabbar, and so it's kind of evolving. But if you like business, if you like sport, I think you'll really like it.
How many episodes?
I've got no idea. It's only 2. It's on Binge, which I don't love Binge. I think it's pretty crappy. The user interface I just can't work it out. But I've managed to get to this. So every week they're releasing an episode. Maybe wait to the end of the season. Is that what they're doing? Okay.
Yeah, 10 episodes.
And I imagine they'll go through, like early 80s. Maybe only 79,
yeah, that
80,
looks
81,
sick.
82. Yeah, it's really cool. And they Red Auerbach, who's the legendary Celtics coach, there's a really great interaction between Jerry Buss and Auerbach right at the start of the end of the 79, start of the 80 season. And it kind of just sets the scene, the Lakers Celtics. I can see it's going to be really good. So
that's 100% going to be on my list.
Highly recommended.
But I'm going to wait till they're all out and then just
get your free 2-week trial. And then you don't have to put up with binge.
I have to wait. It's 10 weeks, so just do it for 2 weeks. It's the last episode is released.
How are you finding
8th of May. Wikipedia, man. It's got the answer to everything.
Okay.
8th of May, 2022 is the release date.
All right.
So, okay. So I'm on Amazon Prime. Deb ordered something on Prime, and if you signed up for the Prime Video, you got free delivery.
Oh, yes.
And you got a free trial of the thing. So we got free delivery of whatever she bought, and it came like the next day. And then we got Prime. Watching a show that's called This Is Us.
Oh, yeah.
Have you seen it?
Such a great show. My wife loves this
Man,
show.
it
Just
is...
loves it. It's so dynamic.
So
anyway, I'll let you go.
All of the... It's just this one family, and it goes through their journey. And it goes from... It flashes back to when, this couple were younger before they had kids, after they had children. It fast forwards into the future. It's constantly moving in and out of different generations. And what is just fascinating for me, and it's just this reminder how these little synchronicities in life have one, you have one little thing that impacts your whole life in a whole new direction.
Yep.
And to me, it just shows how... precious life is, and what we do and who we interact with and how we treat them, and small decisions that we make in life, what happens after that. And man, it's good.
Yeah.
I don't know how many episodes we've been watching. 4, 5, 6.
A few seasons.
Yeah. Oh, that's right. Deb said there's 5 seasons.
It used to be on Channel 10, I think.
Oh, there's 6 seasons. We're only up to season 1.
Yeah, man, it is really good. And man, it takes you on an emotional roller coaster.
Have you watched it?
Yeah, I've probably seen the first 3.5 seasons.
Right, okay.
Laura is, show cheating on me. She's just raced ahead because she just loves it. But I can't keep up. I've got too much else to watch.
That's good.
Yeah,
man.
that's a highly recommended, really good show.
And you can kind of pick it up wherever you left off.
Yeah.
It's not one you have to binge or anything like that.
Agreed.
Look, let's wrap up. Again, we've had a couple of emails come through. So what we might try and do is do a listener mailbag next week.
Look
We'll
out.
try and tackle those couple of emails that came through the other day. Jump on YouTube and Apple, Spotify, Google, and we have hit 100 subs on YouTube, which is
Where are the streamers?
excellent milestone. No, I've got a special notice from YouTube saying congratulations. You hit
Oh, really?
100 subs. Yeah.
All right.
So flick us a note, info@baharianwealth.com.au, and we'll see you next week.
See you next week.